The Strait of Hormuz is the world's most sensitive maritime artery. For global energy, this choke point is the site of a total systemic breakdown. On April 21, 2026, the U.S. announced an indefinite extension of the ceasefire with Iran. But for markets, this extension is a misnomer. It offers no real cessation of hostilities. President Trump directed the military to rigorously enforce a naval blockade of all Iranian ports. The blockade remains active even as diplomatic talks continue. This temporary reprieve was brokered largely by Pakistani Prime Minister Shehbaz Sharif, intended to give Iranian representatives time to formulate a diplomatic proposal in Islamabad. The Iranian leadership has already rejected those terms. They characterize the ongoing blockade as an act of war and maritime piracy, refusing to attend further negotiations until the U.S. Navy withdraws. The global risk premium certainly hasn't vanished. It has shifted from the threat of airstrikes to a protracted war of economic attrition. This state of suspended conflict creates a massive supply-side shock that is currently tearing through every layer of the global market. Brent crude has reverted to $98 a barrel, while the 10-year Treasury yield has jumped to 4.46%, its highest level in a year. Institutional anxiety is visible in the demand for gold, which is holding near $4,800 an ounce. Even with a strong U.S. dollar, investors are paying a massive premium to hedge against a total breakdown of the financial architecture. For chief financial officers and portfolio managers, this intersection of high yields and physical energy shortages makes legacy capital allocation models unsustainable. Surviving the remainder of 2026 requires a defensive pivot, abandoning just-in-time optimization for fortress liquidity and total supply chain de-risking. This is the physical reality of the Hormuz blockade. Millions of barrels of production are physically stranded, creating a massive deficit in immediate supply. While analysts focus on the 12 million barrel per day oil shortage, the deeper structural threat to the global economy involves a different set of commodities. This chart tracks the Arabian Gulf's massive share of seaborne exports. It provides 46% of the world's urea and half of its sulfur, guaranteeing structural food inflation if severed. It also produces 1/3 of global helium, an irreplaceable input for AI hardware. This multi-sector dislocation creates a supply-driven stagflationary environment that traditional central bank policy cannot easily fix. This immediate supply shock places the Federal Reserve in a strategic trap. A price shock from physical shortages of energy and industrial materials is immune to demand-side monetary tightening. Rate hikes will only deepen the economic contraction, but cutting rates will not drill more oil or clear a naval blockade in the Arabian Sea. This FOMC dot plot illustrates the market's violent repricing of reality. Anticipated rate cuts have completely disappeared, replaced by a higher-for-longer trajectory that extends through 2027. The Fed is facing intense political pressure to cut rates and stimulate the economy, but capitulating now would unanchor long-term inflation expectations, potentially triggering a catastrophic spike in bond yields. Corporate borrowing costs are likely to remain punitively high. CFOs will have to defend their profit margins through operational efficiency and aggressive pricing power alone. Concurrent with the naval blockade, the Treasury has launched Operation Economic Fury, a campaign designed to dismantle Iranian oil smuggling and proxy networks. The administration is weaponizing the U.S. dollar by applying secondary sanctions to any international entity that facilitates these Iranian transactions. Global banks are being forced to make a binary choice: stop doing business with Iranian-linked networks or lose all access to the U.S. financial system. This network maps global trade finance. Watch when a single Tier 3 supplier in Oman is flagged for a sanctions violation. The contagion moves instantly, turning the central node red and severing the parent company's access to dollar liquidity. Opaque, multi-tiered supply chains now represent acute existential risks to corporate compliance and liquidity. This level of volatility makes traditional risk management functionally obsolete. Passive commodity hedging is now a source of capital destruction. This chart visualizes backwardation in crude oil futures. The price for immediate delivery is significantly higher than future delivery. Rolling near-term contracts forward creates a negative roll yield, causing the corporation to lose money just maintaining price protection. CFOs must pivot to active option strategies, like out-of-the-money call spreads, to protect against catastrophic price spikes without locking in today's inflated baseline. Trade policy is adding to the chaos. The new 50% tariff on imported copper is significantly increasing the capital expenditure required for high-intensity tech infrastructure and energy projects. A simultaneous breakdown in hedging efficiency and trade policy shatters standard forecasting, making long-term capital expenditure planning nearly impossible. Navigating a fragmented, sanctioned global economy requires a total shift in capital allocation. Treasuries must move away from just-in-time logic toward just-in-case models, prioritizing the maximization of physical cash and liquid reserves. A sudden, massive liquidity injection if arriving via the $166 billion Section 122 tariff refund mandated by the Supreme Court. Organizations entitled to these refunds must deploy them tactically. This windfall should be used strictly to pay down high-interest floating-rate debt and bolster liquidity buffers. In this macro environment, balance sheet resilience strictly supersedes any speculative growth initiatives or aggressive mergers and acquisitions. It is a mistake to build financial models on the hope of a rapid diplomatic resolution or a central bank pivot. Corporate leadership must execute deep-tier supplier audits to ensure they aren't caught in the secondary sanction net of Operation Economic Fury. The gold market is the ultimate indicator of institutional sentiment. The sustained high price reflects underlying dread regarding the future of the financial system. Smart money is positioned for further systemic shocks. To survive 2026, corporate leadership must adopt a hyper-defensive, fortress-like posture today.